Hello, this is Nick, and I'm with you to go over the weekly market update for the week of 17th of April. Okay, here over the money market side from 1 month all the way to the 1 year, the rates have not changed that much, but on the capital market side, we had the rates come down 14 basis points in the 10-year. The slope in the capital market compared to money market had inversion, as seen here, mainly because of Powell's speech and the fact that he is not going to move the needle. Since he believes we are at full employment, he can be in a wait-and-see mode. On the capital market side, here, we see more bearish steepening week over week. Moving to Fed funds implied rate probabilities for the 7th of May meeting, it is pricing no cuts, as it is evident here. But we should wait for the PCE and Q1 GDP to decide. However, for the end of the year, the market is pricing more cuts than it did last week, as it is evident here. So you can see the 4 cuts have increased from 26% all the way to 32%, and 5 cuts had increased from 9.7% all the way to 15.5%. Moving on, the real yield have dropped, which is in line with the pullback we've seen in treasuries. That said, if due to tariffs we enter a stagflation regime, you will see the demand for tips to go up compared to treasuries, which will squeeze the real yields. When it comes to break-even rates over here, you had a jump of 13 basis points from last week, which in the 5 years from now, you can see it went up by 13 basis points compared to last week. And I believe like the market is pricing in a more stickiness in inflation, especially over the long run. Moving on to the Fed balance sheet, as you can see here in the assets from last week had decreased by $300 million, and especially when you're near debt ceiling, the Fed is not gonna shrink its assets rapidly, because they don't want to be in a position that there is no more room for them to do that. So they're slowing their pace. But the most important thing here when it comes to rates was the 30-year rate fixed mortgage rate. And as you can see here, even though we are lower than where we started the year, for the 30-year and the 15-year, both of them jumped 21 basis points. Like it's like a one hike. So let's see where that's gonna go. If it's gonna go up, it either could be that it's pricing weakness in the consumers, or that the real 30-year yield is gonna go up in the future, and the treasuries and mortgages are not in line for this week. Moving on to the overnight index swap rates, we have come down all over the board, but let's see how it develops for next week. Prices, again, starting with the break-even rates from 10 to 30 year, it had increased, which showcases the expectation of the market for a stickiness in the inflation. So, they haven't come down. Inflation nowcast, which is published by Fed, even though not accurate, its direction shows how the Fed believes inflation is going to develop. Now, as you can see, they are indicating a disinflationary trend right now, as it is evident in the PCE and core PCE. They are pricing in a 14 basis point decrease in the April core PCE. So last week they had it at 2.64. Now they have it at 2.5, which is interesting. And moving on to the commodities, the main commodity prices over here is US gasoline. It's higher than we started the year, but it's lower from last week. But all in all, it's holding steady. And let's see what the deregulation that this administration is talking about, what impact it's going to have on gasoline prices. Coming to the crude oil is lower than where we started the year, but from last week it's up $3.18. The reason why I believe is not that the market is pricing a rebound in economic activity right now, because of the escalation in the Middle East, especially with the United States and Iran. And around 18 million barrel of oil comes out of Persian Gulf every day. So in case of a real escalation and a conflict, that's going to be a major problem. I don't believe there is a high probability that's going to happen, but I believe that increase in price is because of that. Moving on to official inflation, CPI came down to 2.4% year over year. Core CPI is at 2.8, which is a bit distant from the 2% target of the Fed. Core PPI, but it is really high. It's 3.3%, and it's the price that is the producers are paying, but eventually it's going to translate to CPI. So we need to wait and see where it's going to go, if it's going to come down or not. The main reason that the headline CPI came down in March was because of lower energy prices, lower lodging prices, and lower airfare prices. So the first one is because the market is pricing in demand destruction. That's for one. The second reason is that OPEC, led by Saudi Arabia, said we are going to increase production. So, and they are going to move from their policy of doing cuts, I believe. If they do that, it's going to for sure bring down inflation, because energy is the first part of the economy, and especially oil is the marginal energy provider. So when you have uptick in economic activity, the first resource that is going to get used is not nuclear or gas. It is going to be crude oil, because it's easily transferable to any place in the world, and you can easily set up plants, and it is cleaner than some other resources like coal. So that's the reason I believe if they manage to bring down oil prices or keep them low, it's gonna be demand stimulative. Moving on to inflation measures. Average hourly earning is 3.8% year over year, which is still a bit high. And moving on to Zuri. Zuri is published by Zillow, which is for rent. It's from 35th percentile all the way to the 65th percentile of the asking price for rent. So it does not take into effect the impact of the incentives that the home builders and the landlords have in their campaigns. But it's held steady at around 3.5% year over year. Import prices in March only increased 0.9% year over year, but let's see where it's gonna go, especially after April, especially in May, when all of the tariffs are gonna be in effect. PMI manufacturing prices and PMI services prices, both of them are in expansive territory, and they're increasing, and manufacturing is increasing at a faster rate. Government credit. So when it comes to government credit, we can see that the yields have dropped all over the board, that's for sure. And if we look here, we have tips here, and for tips, except for the 0 to 1 year, all of them had dropped. As I told you, like, we need to pay attention to the 0 to 1 year, because here market is pricing in stagflation. So you can get the boost from Fed cutting at the end of the year, while you might have inflation at the same time because of tariffs if they remain in place. So we need to have more data, especially when we go to June and July. Then it's gonna be more clear where we are headed. And if you had government credit, highest weekly return is for 7 to 10 year treasury basket with 1.19% weekly, and the equivalent in tips is also 7 to 10 year with 1.24% return over here and here. And municipals up 1.2% week over week. Moving on to corporate credit, we had a huge jump in triple C and lower from where we started the year, and a 15 basis point decrease week over week will not change anything here. We need to see that the option spreads are gonna go like at least near 7 in order to be certain that there is not going to be a recession. But like at 10%, the market is for sure pricing in a recession. Moving on to the fiscal side, interest spending up 10% year over year over here. And these figures are all year to date, so from January all the way to 17th of April. Deficit grew 3.67% year over year, year to date, and tariffs so far only increased revenue by around $6 billion, which was an increase of 23% from where we were last year this time. So as you can see, like, we need to see what the impact of the tariffs are going to be. If we are going to have less imports and the consumer is going to cut from its spending and cut from its consumption, then the government is not going to make like any revenue here, or like at least any real revenue. Like a couple of $1 billion in the US government budget doesn't make a difference. Okay, so we are going to wait for more data, especially in the middle of May. Moving on, labor conditions. Initial claims only at 215K, but what is important here is that continued claims, which is for 2 weeks ago, had crept up to 1,885,000, which is an increase of 41,000. So it shows maybe, like, even though not so many people are losing their jobs, but the ones that lose find it harder to find a new job. Going on to the ISM manufacturing employment, it was in the expansive territory in the beginning of the rate when there was no real talks about tariffs, but now they are in contraction. So for sure, like for the short term, the tariffs are not going to help employment, especially in the manufacturing sector. And in services, it also dropped. It was even like expansive in February, but then again it dropped in March when you had more talk about tariffs. Unemployment had increased 0.1% in past 2 months, and it sits at 4.2, which is a good level of employment. Participation rate is steady around 62.5%, And average weekly hours is also steady and at 34 hours point 2. It shows that the market is holding up, at least the labor market. ADP, in March they reported that the private market had added 155,000 jobs. So labor conditions till now is good, but let's see where it's going to take us from here. And when I was reading some of the reports, some companies are reporting that we are doing soft hiring freezes. We are not laying off people. And they used to say like we have a hiring freeze, but now they say we have like a soft hiring freeze, which means like they want to see where the tariffs is going to take them so they can plan for the future. Okay, consumer and sales. Real personal income is up 1.8% year over year. Over here, real retail and food services sales is up 2.15%, which is also good because in February it was flat and the market was getting worried, but now it had increased. ISM manufacturing right now is in a contraction, 49. It was in an expansive territory. And services is also dropping, but it's in the expansive territory as of now that we're talking. So I think April is going to be a bit different. Moving on to the merchant wholesalers. Merchant wholesalers is up 4.3% year over year, but you need to take inflation into account because it's not real increase in sales. It doesn't take into account inflation. Inventory to sales ratio, because of front running, I expected to see a bit of volatility, and it's gonna go up in the beginning, but then again when we have more data about the tariffs and when they are like in place and you are not gonna have any more negotiations, then they are gonna reach a level, like a steady level again. Michigan consumer sentiment is dropping rapidly, and the most important thing about it is that the market is again pricing in inflation, at least the market participants. I'm not saying it's accurate. Even in the height of 2022 inflation, the Michigan inflation expectation wasn't right, but its increase shows the direction of the market thinks that it's going to take. And when the market is pricing in inflation, consumer is going to cut back from its spending. Okay, going over the PMI in depth. In services, new export orders have moved from expansive to contracting territory, and imports have moved from contracting to expansive. Exactly the opposite effect that the administration was hoping for. And some part of it is because of front running, but then again we need to wait and get more data, especially in April. It's going to be so important. On the manufacturing side, it's again the same picture to some extent. New export orders, it entered contracting territory, and imports is in expansive territory but at a slower rate as of now. Okay, moving on to factors performance. So you had your S&P 500, which is your core large, decreased weekly by 1.5%, but the real outperformer year to date was low volatility. So in low volatility you get, especially large low volatility, you get your big utilities, defensive companies, consumer staples, that their prices don't change day to day, and that's the reason that they're performing well. And also when it comes to revenue, they don't have that much exposure outside of the US. And if they're going to keep performing this good, I believe some of them you're going to see eventually move also to momentum as well. So it's going to impact momentum in the next weighting. Sectors. When it comes to sectors, year to date, consumer staples and utilities outperformed the market. And from a week ago, it was real estate and energy. And energy because the oil prices are going up, so that's because of that. And here you have the ETFs corresponding to the sectors. And you have, like, even though the stocks themselves had decreased week over week, the XLF had increased by 1.61%, which is really interesting. Industries. Year over year, you need to look at oil and gas equipment and exploration over here and here, because they are really cyclical. And given that right now oil prices are down, they are underperforming the market. So they have a real cyclical nature that we need to pay attention to. If the market is gonna come back, you need to look at these two. Otherwise, it's not a real correction, I would say. Industry performance. In the next chart, in the next table, we have some other industries, and over here we have semiconductors down week over week because of restrictions and curbs when it comes to China, especially Nvidia, which is going to get more strict in the future because it's a national security issue. And when it comes to prosperity and national security, it's like national security is gonna win each time. Even like Adam Smith, he says when it comes to national security, when it comes to security and opulence, a state should choose security, even though he was proponent of free markets and everything. But security comes first and then prosperity in the minds of the government. Moving on to commodities. Commodities here, week over week, you had WTI going up 5%, which, as I told you, one part is because of the Trump administration had canceled the reciprocal tariffs that they came up with. But again, market is baking into the pricing the conflict in Middle East and its potential for escalating from here. And coal is up week over week, and let's see where that's gonna go. Uranium is up week over week. Gold was the real outperformer year to date, 25%. One is because of the weaker dollar, and the second reason is because your treasuries is not acting like safe haven and liquidities are dropping. So the only option is either you move to other countries like Europe, or you go gold, which is going to preserve its value and increase in value because dollar is depreciating. And copper is up 3.52% week over week. Also, as I said, is because of the weaker dollar. If it persists in the next week and like next month, then maybe you can say that the market is pricing in a construction boom, at least in the US. When you go to agriculture side, wheat is down 6% year over year, soybeans is down 10%, and you have lots of trade when it comes to China. So that's one thing you need to keep an eye on. Corn is up 7%. So when we go like to the, especially in the July and August, that's where is the prices is going to be more important, because then you have all the crops, and then it's going to define the price. Lumber, housing is up 12% year over year. If the tariffs also come on top of that, then that's going to make a problem for the house builders. They're talking about deregulation and like freeing up some lumber in the US, but that's going to take a bit of time, and like you need at least to wait like 6 to 9 months, because you need all the supply chain and like everything. Live cattle, even though it's not like really defining here, but it's interesting, like the live cattle prices are increasing year over year, year to date, week over week, and let's see where it's gonna go from here. If it's gonna come down or if it's gonna go up. If it's gonna go up more than this, then I believe that there are gonna be more players entering the market. Asset classes. So, as I told you, when it comes to asset classes performance, gold outperformed any other asset classes out there. Also, Europe, ex-UK, year over year up 10%, and these are all total returns compared to S&P 500, which had a year over year of 7.7%. WTI down 22%, and also one part of that is because you have excess supply in the market, and you have spare capacity. So it's not that like all of that is demand destruction. Some part of it is because you have better supply economics, and then it's gonna have a negative pressure on oil prices. IG credit up 6.93%. And I believe like some of the players in the high yield are gonna move up to investment grade, so it's gonna support it. But then again, if the dollar is gonna depreciate, then you are gonna have a problem. Then you are gonna have international players in the States having problem with both treasuries dropping and dollar dropping. So it's like that they have a structured instrument, so they're gonna lose on both sides. And US dollar year to date is down 9.15%. Risk levels were really high even this week, and they didn't come down because the market is pricing in more volatility in the coming months, especially in the 9-day. You see, you reached 56. VIX itself reached 45 this week, and right now it finished at 29.65, which is it's equivalent to plus minus 1.87% decrease, or like increase or decrease every day. So like swings of over 1.5% each day, that's really high, and it's gonna weigh on valuations. OVX, as I told you, it reached 53. The situation in the Middle East is a bit serious, and the markets are pricing that. Again, I'm not saying like the odds of that happening is high, but if it happens, the consequences are so severe that you need to hedge yourself, especially if you play in oil and gas. Moving on to fixed income, estimated volatility, MOVE index was high. It's down from its week high of 137, but it's elevated at 114%. Coming to tactical positioning, dispersion finished the market as 38.94%, and the market is pricing in tactical positioning right now. So market is not pricing in risk on. You need to pick names right now. And when it comes to SQ, at 130, it's still high. So market is pricing in a tail event again in the coming weeks and months. Okay, so the last page that we have here is the oil demand and supply page. Here I brought all the big oil and gas producers around the world. So this one, published by S&P, has all the developed and emerging markets oil and gas producers, but it doesn't have Russia and Saudi Arabia, Aramco. So because of that, I brought them separately. As you can see, oil and gas globally was up, like producers was up 4.29%. One part of that is because the price of the risk had decreased by around 7.9%. Also, Russia had increased in US dollars more than the global oil and gas index. The reason why is because the market is pricing in lifting of the sanctions. But it is interesting, even the Saudi Real is pegged to the US dollar. Aramco had increased only 1.18%. It could be due to two reasons. One, low liquidity, or two, risk in Middle East. And I believe it's more of the second situation than the first one. The 3-2-1 crack spread, it's up 3.55%, and it stands at 24.22, which shows that the market is steady as of now, and like there is demand for gasoline and heating oil. Moving on to the EIA weekly report. Total crude oil production 13.5, steady. That's a good level to be at. Inventory steady, and from last year it's down 17 million barrels. Refinery gross crude input 15.8 barrels a day, which is a good level. Capacity utilization is at 86.3. It's not as high as last year, but I would say it's at a good level. When they compare it to the 5-year average, we need to take into account that you had the COVID era there too, so it's not really that much comparable. But again, it's higher than the 5-year average. Moving to the gasoline supply was up 8.5. Its production also was up, and the stock had decreased, which is a good sign for the when it comes to demand. But we need to wait and see what's gonna happen moving forward. And also, like, you're near summer, and the summer is just around the corner, so that can also affect the gasoline stock and like supply. Distillate supply down 100,000 barrels. Its production is steady, and the stock is down. So considering that its stock is down, we can say the demand for the distillate is also good as of now. But these are for 11th of April. We need to wait for more data, especially near the end of April and mid-May. So this was the report for this week. See you next week.